Hey there, ever heard of the fear gauge shaking up Wall Street headlines? That's the VIX, and today I'm breaking down exactly what it is and why it matters for investors like you. So what is the VIX? The VIX, or CBOE Volatility Index, measures the market's expectation of volatility over the next 30 days. In simple terms, it tells us how jumpy traders think the stock market's about to get. When investors get nervous, the VIX tends to spike. That's why it's called the fear index. Now, how is this thing calculated? It's all based on S&P 500 options prices, mainly those that are just out of the money and set to expire soon. If people are willing to pay higher premiums for these options, it means the market is bracing for big swings ahead. Higher option prices, higher VIX. But what do those VIX numbers even mean? Here's a quick cheat sheet. If the VIX is below 15, markets are chill. Between 15 and 25, totally normal jitters. Above 25, investors are sweating. If it shoots over 35, that's panic territory, usually linked to stuff like financial crises or global shocks. But remember, the VIX isn't about predicting direction, just how wild the ride might get. Let's put this in context. Back in March 2020, when COVID rocked the world, the VIX soared past 80. That's historic fear. In 2022, with inflation, rate hikes, and war in Ukraine, the VIX kept popping above 30. Even now, in 2025, the VIX is still the go-to indicator for market nerves. So how do traders actually use the VIX? Some hedge with VIX futures or options to protect their portfolios. Others speculate on where volatility's heading. Analysts check VIX trends to gauge sentiment, and some investors use extreme VIX levels to time their moves, hoping to go against the crowd. You can even trade VIX-linked products, like VIX ETFs and ETPs, names like VXX, UVXY, or SVXY. But heads up, these aren't your basic index funds. They're complex, and they don't always act the way you might expect, especially if you're holding them long-term. It's also important to know the VIX isn't perfect. It measures expected, not actual volatility. It can give false alarms, and sometimes it lags behind what's really happening. It's best used alongside other tools and research. So, here's the takeaway. The VIX gives you a peek into the market's mood, and understanding it can make you a smarter investor. But don't use it in isolation. Thanks for sticking around to decode the VIX with me. If you found this helpful, hit that like button, share with your fellow investors, and subscribe for more deep dives into finance. Stay curious and see you in the next one.